Imagine that for your promise, I will give you $100 cash right now. Hello traders, welcome to the new video. Today we will talk about selling put options. So selling put options is basically you are giving me a word that an exact date and an exact strike price you promise me to buy the stock. Let's say Apple is now trading at $150 and you say that you are going to buy at $140 level. So I come and say you this. Okay, if you promise me you're going to buy Apple shares at $140 next week, I can give you now $50 upfront payment, which we call premium. So if stock doesn't come here, you will keep your money. I don't ask it back from you. But if stock price come to even $130, you promise me buy it from $140 level. But you are also keeping your $50 premium. So let's check it on the live screen now. And now we are in the ameritrade. We will take a look together how we can make some nice sweet profits with our promise to the traders. Currently I have a covered call position, which is something totally different. Today we will talk about selling put options. So as I said before, you are obligated to buy shares at your strike price. So now let's take a look at the 4 February. It is now 15 days from now on, and currently Apple is trading at 166, and let's say you would like to buy Apple if stock comes to a $150, right? What you gonna do? You come and create a buy order, which we call the limit order, right? And you will type, if stocks come to a $150, I would like to buy this stock. The only important thing here with the options, one contract means that 100 shares. So be careful about that and don't use so much leverage because it can kill you. Let's continue. So let's say you are okay to buy from $150 and I can say you don't put a limit order. Come to option chain and sell a put option, which means that you click the bid button from the put side, right? So what you are going to do is you are promising me that you will buy a 100 shares from $150. Even on 4 February price is $100, you are going to buy from $150. This is the risk of selling put options. So don't sell a put in stock that you don't want to own, because you can end up with 100 shares the stock that you don't like. So the quick note is you can see here IVs, which is implied volatility. As long as it is high, it gives a higher premium. So there is no fixed price that if you spend or if you're going to enter $15,000 position, we will give you $100. It's not working like that. So if you spend $15,000 on Apple, you can get, as you can see, $77. But if you do the same thing and if you spend the same budget on, let's say, Peloton stock, you can easily get maybe $500. But it's a risk reward. Don't forget that. So let's say 4 February has arrived and you have one sell put option and price is currently trading at $160. So even if you have a limit order, it didn't feel right, so no problem. But what you did is you sold a put option. So you received, let's say, $80 premium 15 days ago. The first day you have entered the position. So you get the money in the same day. So if stock is trading above your strike price, your position will close automatically and you kept the money you received from the option position. Yes, that is true. Why you keeping the premium is because you took a risk that and you created a liquidity for all the market. So that's why they are giving you, and I mean that the put buyers is ready to give you that money. So that's how it works. And let's say the worst scenario can be is the stock has dropped significantly, let's say 30%, and Apple now trading at $110 level. So what will happen is you will have 100 shares from $150 level and your cost will be $15,000 minus the premium that you received, which means like if you receive a $70, so your cost will be $15,000 minus $70. So it's a nice thing. So in any way, if you're going to buy the stock, this is a best way to buy a stock. So don't create a limit order if you would like to buy a stock from a deep price. I mean, if you're going to put a limit order for $100, for sure that you will not get anything. But I mean that if you're going to put an order for like, I don't know, 10%, 15% below the current price, you will get some nice premiums. And if you go far out of the expiration dates, you can see that your premium will increase. Why? Because the risk you are taking is going much higher. Even if the stock goes up, there's a risk, right? Anything can happen in the stock market. So before we finish this video, there is also one important thing that some of the traders doesn't know, that you can actively trade options. What I mean is if you open a selling a put option position, you can close anytime you want. Let's say now I sold a put option now, and on Monday Apple has reached $180 level again, and most probably this contract will be trading level of 30 cents or so, which means that I will make a profit of $40. And you need to multiply by 100 these numbers to calculate your premiums. Let's say if this is 0.70 cent, means that you need to multiply by 100 and you can now calculate your premium, which is $70. So that's all for this video. I hope you like it, and go and check it out, which stocks you can buy, which stocks you can do selling put options, because it's a nice passive income for your portfolio. And in the next series I will show you how to do a covered call position to receive again a passive income. So don't forget to subscribe my channel, it motivates me a lot, and hit the like button, and see you next time.